Let's bring in Mark Haefele. He is Global Chief Investment Officer at UBS Wealth Management. And Mark is now officially my favorite guest of the week. He is also my first guest of the week because any man who references the classic Apocalypse Now movie in their latest research note is okay by us. You talk about helicopter money. What do you mean by that? And what are your concerns right now, Mark?
Well, thank you for that wonderful opening. And I've got to say, you're my favorite host, starting with the GNR this week. So wonderful.
Nice.
We're very simpatico. So, yeah. So, look, I think what we were referring to is the press conference with Mario Draghi, where he was asked about helicopter money in Europe. And he said, that is a fiscal matter. That is one for the politicians, although I think that fiscal policy is needed. And he's followed up on those comments about what he thinks it will take for Europe to move their economy ahead, and it's not based on monetary policy. And so what we're saying broadly is that monetary policy now can help us on the downside, probably prevent something like a recession. But for the upside for risk assets, the upside for equities, we're going to probably need some fiscal stimulus or some better data to drive returns from here after a great year.
Well, what's interesting, and by the way, thank you for that, Mark. What's interesting is that globally, you are recommending an underweight on stocks. But there's a caveat. You believe the United States equity market will do proportionally better than other places from a stock perspective. So does that mean you expect us to fall less, or do you think the U.S. markets can still gain more?
Well, I think, broadly around here, maybe flat, slightly up, but, maybe a little down, not kind of lackluster. Where we would put our overweights right now is on credit and getting some yield, and we still see a tremendous demand for yield from our clients. So on a risk-reward basis, we would like to clip some coupons into the end of the year until we see either the economic data improving or we do get a trade deal. And that's why I think you have to hesitate on what the equity markets are going to do, because we acknowledge that if we do get a trade deal, then the picture looks somewhat different.
Well, where can we find yield right now? I mean, I think that's the great scavenger hunt globally, Mark, because there was an article in the Wall Street Journal yesterday about how some high-income clients are buying things like cocoa and butter futures, anything you can to generate any kind of return. So where are you guys at UBS seeing that right now?
Yeah. Well, we would point investors to TIPS. We'd also look at U.S. dollar-denominated emerging market sovereign bonds having a yield pickup, and then also to a basket of EM currencies that have a higher yield than some developed market currencies. So you're right that investors are looking more globally for yield, even in the United States.
Yeah, and you also recommend, we haven't heard this much at all, Mark, something called TIPS. I'm not talking about what you leave at a restaurant. I'm talking about Treasury inflation-protected securities. Now, what I know about TIPS is that they're safe. When inflation goes up, they can gain a little, but you're not going to ever get a big return on TIPS. Does that kind of sort of, I guess from a 30,000-foot perspective, sort of sum up what you're talking about here? Take what you can get type of return market?
I think that it is a market, not just over the near term, but over the medium term, where investors are going to probably have to accept lower yields and lower returns because some of the fiscal stimulus that we saw after the U.S. tax cuts has come out. The very low yields on debt globally mean that we've taken a lot of the returns forward now, pushed by the fact that discount rates have fallen already. They probably can't fall that much further.
Mark Haefele of UBS out in Zurich, Switzerland. Mark, perfect time there. We appreciate it very much. Have a great week. We'll see you soon. Thank you.